Welcome to the Taxingly podcast, episode 1. My name's Andy Wood. I'm a chartered tax advisor, a non-practicing barrister, and I've worked in tax for about 20 years. And I totally agree with you, that's quite some time to be stuck in a rut. The idea behind this podcast is to talk about a couple of topical and hopefully interesting tax matters on a weekly basis. Today, we'll talk about, first of all, the long-awaited report of Sir Amias Morse into the controversial loan charge, and then secondly, we will look at recent reports suggesting that entrepreneurs' relief may well bite the dust. So topic 1, the loan charge and the loan charge independent review. First of all, a topical and interesting story in my view, but also an extremely controversial one. And this isn't the place to go into a sort of detailed history of the development of the legislation, which sort of gave birth to the loan charge or the mischief it was trying to curtail. However, I think some explanation is required to put the loan charge into some kind of context. So, first of all, throughout the 2000s, there were many companies, many employers who offered arrangements where part of an individual's remuneration would be paid by the employer to a trust, even where there may be no contractual right to such a payment. Generally, when that payment was made by the trustee, they would collect the money and then, by and large, they would make a loan to the employee. The argument was a relatively straightforward one, that the capital of that loan was not taxable as earnings. Of course, one of the most famous users of this type of scheme was that Rangers Football Club, and we will come to that tale shortly. So, what was the tax position of this type of scheme? I suppose that's the $64,000 question, really. I suppose it won't come as a huge surprise to tell you that HMRC weren't exactly cock-a-hoop with this type of arrangement, and their argument was that loans, well, they were simply taxable. They were just essentially disguised earnings. However, they didn't have a great deal of success with that argument in the courts, and that's putting things lightly. So in December 2010, the government decided enough was enough and introduced some new legislation, often referred to as disguised remuneration legislation, which was meant to put clear the desired position of the government. And of course, changing a law going forward is totally in the government's gift. So this legislation essentially applied where there was a link between an employer and an employee, and also where the payment or the disguised remuneration was made through a third party. So this didn't include, for example, a loan made directly from the employer to the employee. And it's worth noting that legislation essentially prevented any existing schemes from making new loans. It didn't make any attempt to tax the loans already made by that scheme. So essentially it put these existing schemes into essentially into hibernation. It mothballed them. Further, the law did nothing to attack self-employed schemes, and the legislation to challenge the self-employed variants didn't come along until 2017. Enter stage left, the loan charge. In 2016, and actually before we'd had heard the decision of the Supreme Court in Rangers, the government launched its nuclear solution to these loan-based schemes, and this was, as you will have guessed, what is referred to as the loan charge. Essentially what the government was doing was announcing that it was going to impose a PAYE liability on any loan balances paid under those schemes outstanding on the 5th of April 2019. So a couple of years notice for what that was worth. It would apply to any loan taken out and not repaid since 1999. So 20-year look back, clearly a very strong and retrospective piece of legislation, pernicious even. This legislation has now come into effect, and the loan charge essentially technically triggered on April the 2019. But this is by no means the end of the story. So you may think, I suppose, that if this charge did trigger in April 2019, why was there a review? A bit late, some may say. And there is plenty of truth to that. But essentially the reason why there was a review is that many of the people using these schemes were contractors. And those contractors were very effective, mobilising themselves into a consumer action group known as the Loan Charge Action Group. In turn, LCAG and other parties, such as the professional bodies, mobilised the members of Parliament who, after taking a little bit of time to get to grip with the issues, registered unprecedented support for the loan charge, the anti-loan charge movement, I suppose. Initially, this support was successful in winning some minor concessions from HMRC, generally speaking, around time to pay arrangements, so how you can perhaps manage a liability under this legislation. However, that was at best window dressing. The first real solo moves happened in May 2018 when an early day motion was tabled by Stephen Lloyd, who was then a Liberal Democrat MP. So he had some particularly deep concerns with the provisions. I met Stephen around that time, but he was just one of a number of MPs who had shown an appetite, as I say, to get to grips with the tax law and fight their constituents' corners, particularly because these provisions were retrospective in nature. And that early day motion currently has, last time I looked, a few days ago, 152 signatures. This was then followed by something called New Clause 26, which was a cross-party amendment to the finance bill, again proposed by a Liberal Democrat MP, this time Sir Edward Davey, and the aim of that clause was to seek a review of the loan charge. That amendment passed unopposed in Parliament, the only dissenting voice being Mel Stride, a former Treasury Minister, no one seemingly prepared to support the pariah legislation, which was the loan charge. Eventually, a full review was ordered by the government, and they appointed former National Audit Office head honcho, Sir Amyas Morse, as the person to steer that report. There's a call to evidence, to which I provided a written submission. The aim of the report was originally due to report back in November 2019, but that was delayed by the election. Finally, it was released on the last Friday before Christmas, Friday the 20th. Merry Christmas, everybody. The report itself, albeit it acknowledged the need for some kind of policy to counteract these undesirable schemes. It was pretty critical of the loan charge itself. The long and short of it was it made two substantial changes to the legislation, or proposed two substantial changes to legislation. That was removal of all loans taken out before the 9th of December 2010, and also the removal of loans taken out after that date, which were not open years, open for inquiry from HMRC, referred to in the report as unprotected years where full disclosure was made. Now, both of those recommendations were accepted by the government. Two important changes to the loan charge there, removing some of the retrospective elements. There are also some other concessions, the payment terms of people who were still within the loan charge. It has to be said that even for loans going that were taken out before 2010, if HMRC were already inquiring into those loans or that scheme use, then HMRC would still be able to use their existing powers to see those inquiries through. Okay, so the big question is really, does the review go far enough? Well, in my view, it does not. The reason why the cut-off date of December 2010 was chosen is because, as I referred to earlier, that's the date at which the new legislation was introduced to stymie those good old-fashioned traditional EBT schemes. However, and therefore, I suppose, using that as a line in the sand does superficially make some sense. In Sir Amias's words, this is the date at which the law became clear, and therefore, any loans made after this date, in Sir Amias's mind, were in conflict of that clear position and should be taxed. Those that were made before that date are not taxable because the law was not clear. Seems well clear, or does it? Well, I don't think it's strictly true, because if one looks at the schemes implemented after December 2010, well, they weren't the same ones as those implemented before 2010. And as I've previously referred to, the new schemes which proliferated after that date were, say, self-employed schemes, or perhaps achieved a similar result in a different order. And it has to be said that then the loan charge does refer to the fact that there's still a supply of these loan schemes even now. Well, those schemes, as far as I've seen, generally involve direct loans, so there is no third party at all. So again, although they could be pulled apart perhaps from other angles, they're not likely to be within Part 7A or the disguised remuneration rules at all. So as such, I think you're going to be able to find a reasonable body of opinion that would say those successor schemes are outside or out with the legislation that came in December 2010. And that is kind of supported by the fact that they had to bring in specific legislation in 2017 and 2018 to block these variations on loan schemes. Implicit in that legislation was that the original rules did not catch those new strains of the loan scheme virus. So in my view, the law was not clear regarding those new schemes and the fact that they were probably outside of the 2010 legislation. So, pick the bones out of that I suppose. But I suppose my feeling is that the independent review doesn't represent the end of the loan charge saga. It's merely the end of the beginning. There's got to be a strong case for all retrospective elements to be removed from the loan charge. And importantly, because those revisions we've talked about earlier require new legislation and will need to pass through Parliament, it provides campaigners with another opportunity to challenge the loan charge, because clearly the new measures are going to be scrutinised further. My view is that if one is looking to curtail future use of schemes, this can be done relatively simply by shifting the risk of non-compliance from the individual, from the worker, to the promoters of the scheme. For example, there's already an existing model on the statute, the Managed Service Company legislation, which allows for underpaid PAYE from employment type schemes to be transferred from the individual to the promoter and potentially to them in their personal capacity. And this is something that promoters of tax schemes are terrified of. And let's not forget that by stripping away the retrospective elements of the loan charge, we're not rendering HMRC completely impotent in relation to the old schemes. They'll still be able to use their existing powers to challenge schemes on the basis of the Ranger's decision. The courts are not going to be sympathetic to any of these EBT-style schemes. They also have weapons such as the General Anti-Abuse Rule in their armoury, and a number of other measures to tidy up old schemes. But my view is they should always have been required to use their existing powers and not some kind of legislative whitewash to paper over the cracks. So, stand up, shake yourself off. It's time for topic number 2, which is about entrepreneurs' relief, everybody's favourite friend. But is entrepreneurs' relief a dead man walking? Why do I ask that question? Well, I mean, and not for the first time, we've seen various media reports over the last couple of weeks regarding the potential demise of our friend Entrepreneurs Relief. What is Entrepreneurs Relief, I hear you say? Well, it's one of a long line of capital gains tax reliefs targeted at those who are either retiring from business or exiting from a business. So, probably in its most common form, Entrepreneurs Relief, or ER, will apply when a business owner sells his or her shares to a third party or family member. In this context, broadly, the business must be a trading company, so can't be an investment company, and he or she must be an employee or officer of the company, so being a director would count, and broadly needs to hold 5% of the shares. And these conditions must be met for 2 years. Up until quite recently, it was just 1 year, but the government saw fit to double the qualifying period. But if one manages to tick all the boxes, the relief is very, very attractive, because on disposal of a qualifying asset, then there is a 10% effective rate of tax. People's ability to claim relief is subject to a cap of £10 million of chargeable gains during their lifetime. So once you've maxed out, any chargeable gains over that 10 million are subject to tax at the main rate of capital gains tax, which is currently at 20% for most assets. So what's the problem with our friend ER? Well, as always the case with these reliefs, it's only the cost, isn't it? Over the last year or so, the Resolution Foundation has been piping up and protesting quite a bit about entrepreneurs' relief and the fact that it estimates that it costs, I put that in inverted commas, the government £2.7 billion per year. And that the problem is that this is 3 times more than the relief was supposed to forecast when our old friend Alistair Darling introduced it, I think, back in 2008 now. So what else? Well, other think tanks aren't too happy about it either. And more recently, former HMRC Big Cheese Sir Edward Throop also came out criticising the relief. So is there a case for the defence? Well, mitigation maybe at least, because it shouldn't really be a surprise that the cost of the relief has exceeded the forecast, because, quite frankly, the shape of entrepreneurs' relief has changed quite significantly in at least 2 respects. First of all, that £10 million lifetime limit that I spoke about just a short while ago was originally set at £1 million. So if I can do my maths, the maximum benefit a person can receive has potentially increased tenfold. And secondly, the cost of this relief is clearly always going to be highly sensitive to the headline rate of capital gains tax. Now, originally, the 10% effective rate of tax compared to a top rate of 18%. So you're potentially saving 8% there. But in the meantime, we've had a top rate of 28%. So this has effectively doubled the potential saving an individual can make on a disposal. That was prior, of course, to the main rate falling in 2016 to 20%. Clearly, this has blown the forecasted numbers out of the water. So that criticism that it's over budget is not a particularly solid one in my book. The second problem for ER, though, does it really act as an incentive for people to create businesses? Well, there was a relatively recent survey of entrepreneurs undertaken by the government, and that the figures in that report show that only 8% took entrepreneurs' relief into account when they were starting a business. And also, when it came round to thinking about selling the business, only 16% considered entrepreneurs' relief when looking to time a disposal. So that would seem to indicate that the relief doesn't influence entrepreneurs' behaviour to a huge extent. So if the verdict is, it appears that a relief is expensive and relatively pointless, subject to my points in mitigation above, it's pretty damning evidence, isn't it? So, does entrepreneurs' relief have a future? Well, anybody who was so bored that they read either the Labour Party or the Conservative manifestos at the election would perhaps see that entrepreneurs' relief isn't likely to survive in its current form in the future. The current government have indicated they're going to review and reform it. But scrapping entrepreneurs' relief or something similar is clearly at odds with the policy of successive governments, where, rightly or wrongly, it's been decided that entrepreneurs who sell a business should pay a lower rate of tax on any gain than, say, if someone sells a Banksy painting. And I'm not saying that that's right or wrong. It's just a statement of facts and seems to be something which is ingrained in our tax policy at the moment. Indeed, before we had entrepreneurs relief, we had taper relief, which was divided into non-business asset and business asset taper relief. And before that, we had retirement relief as well. If one looks at the figures, in 2007-08, the last year of operation, taper relief cost the Exchequer 10.7 billion, of which 7.8 billion was business asset taper relief. So with those figures, if one compares entrepreneurs relief to what it replaced, taper relief, then entrepreneurs relief starts to look like a very good value indeed. So it doesn't, in context, seem to be a particularly expensive relief, entrepreneurs relief. Its costs have gone up for very good reasons. And I also think that if the government was to abandon this sort of ingrained, long-standing commitment to those who are growing businesses, they're making the economy go round, it would, I think, send a very negative message indeed. What do I think will be the likely outcome? Well, for cost reasons, I don't think we're going to go back to a taper relief type system. And for the reasons I've set out, I don't think we're going to end up where, somebody sells a family business, pays the same rate of tax as somebody who is selling of ours. So I think entrepreneurs relief will be kept, but perhaps some of the conditions will be further restricted. We've seen a tightening of the belt, entrepreneur relief-wise, and the tightening of the conditions over the past couple of years. So where the definition of the type of shares that qualify has been tightened, and also, I think as I mentioned before, the qualification period has doubled from 1 to 2 years. A further obvious change might be to cut the 10 million lifetime limit, for example, reducing it to, say, £5 million. So if you're an entrepreneur, should you try and cash in on entrepreneurs relief now? Now, when I'm talking to clients, I don't really like to try and scare anybody into action. I don't really like the buy now while stocks last, but I think if you are thinking of a sale in the not too distant future, it might be worth exploring whether some kind of friendly sale could be triggered to bank entrepreneurs relief. And this could be done in a number of ways. So it's probably worth you seeking out formal advice on the matter, and sooner rather than later, because this is probably going to be something which rears its head around the budget time in the next sort of month or two. Okay, so that's all we have time for now on this episode of Taxingly. Hope you found it reasonably interesting. If you've got any tax issues you'd like me to talk about in a future episode, or have any comments whatsoever, then do let me know. But in the meantime, remember, tax might not have to be taxing, but sadly it is. Goodbye.